Netflix had its best financial year in company history. Then its stock fell 34%. Full year 2025 revenue, $45.2 billion. Operating income, $13.3 billion. Free cash flow, $8 billion. Those are not the numbers of a company in trouble. Those are the numbers of a company that won. Yet between its 52-week high in May 2026, Netflix erased more than $90 billion in market capitalization. The business got stronger. The story got smaller. Both things happened at once. The market is not punishing what Netflix is. It is punishing what Netflix cannot become. If you find this kind of analysis useful, the kind that goes past the headline, hit subscribe. Every video goes deeper than the press release. In December 2025, Netflix announced it would acquire Warner Bros. Discovery for $82.7 billion. The assets on offer were real. HBO, the DC franchise, Game of Thrones, a century of studio infrastructure. Netflix wanted the content moat it could not build fast enough on its own. The deal made strategic sense on paper. The price did not. Netflix carried $14.5 billion in long-term debt at the time of the announcement. Analysts estimated the transaction would add up to $59 billion in new debt to its books. That is not leverage. That is a transformation of the company's entire financial identity, from a cash-generating streaming platform into one of the most indebted entertainment companies ever assembled. The breakup fee alone was $5.8 billion. Standard M&A fees run 3 to 4%. Netflix negotiated a fee nearly double the industry norm. The size of that number was not confidence. It was insurance against a regulatory fight the company knew was coming. The deal collapsed anyway. Paramount Skydance launched a hostile counterbid, the Warner Brothers. Discovery Board faced a choice between Netflix's leverage certainty and Paramount's proposed transaction, which filings described as what would have been the largest leveraged buyout in history, carrying $87 billion in total pro forma gross debt at 7 times leverage. The WBD board called Paramount's structure reckless. Netflix lost the bid regardless. The founder left the same quarter. Reed Hastings stepped down as chairman in April 2026 after 29 years. The Q2 2026 guidance missed analyst expectations. On earnings day, April 23rd, 3 simultaneous shocks hit the same stock. Netflix fell 10% in a single session. 3 events, 1 day, $90 billion gone over the course of a year. There's a number inside Netflix's Q1 2026 earnings report that most headlines buried. The company reported revenue of $12.2 billion, a 16% year-over-year increase. That looked like continuation. What the filing showed was that $2.8 billion of that revenue was the Warner Brothers. Discovery merger termination fee, a one-time item, a payment from a failed deal booked as revenue in the quarter the deal died. Strip that out and the organic growth picture is materially softer. The beat contained a receipt from a transaction that will never close. Q2, Q3, and Q4 will not have that receipt. The question the market is now asking is simple. What funds the content machine instead? Netflix guided approximately $18 billion in cash content spending for 2025. At the Morgan Stanley Technology, Media and Telecom Conference in March 2025, CFO Spencer Neumann described that number as not anywhere near a ceiling. The company projected approximately $20 billion for 2026. Total streaming content obligations, including off-balance sheet commitments not yet meeting recognition criteria, stood at $24.1 billion as of Q1 2026. That number is rising even as the growth story decelerates. Content spending is not discretionary. It is competitive survival. Netflix stops spending and the library degrades. Subscribers leave for platforms that did not stop. The company keeps spending and the debt load grows. There is no exit from that loop. There is only the question of how expensive the loop gets. The subscriber machine that justified 15 years of premium valuation is changing gear. Netflix reached 301.6 million paid members in Q1 2025. That sounds like dominance. The filings tell a more precise story. North American revenue grew 9% in Q1 2025 versus 15% in Q4 2024. The company's own communications described the US and Canada market as entering mature growth characteristics. The next subscribers come from markets with lower average revenue per user and higher churn. The global headline number stays large. The unit economics shift underneath it. If North American growth has plateaued and the Warner Brothers acquisition is off the table, the question becomes structural. What does the premium multiple rest on? At its April 2025 peak, before the split adjustment, Netflix traded above $1,100 per share. Analysts estimated its discounted cash flow intrinsic value at approximately $169. The gap between those two numbers was not irrational exuberance in the casual sense. It was a deliberate bet that Netflix would keep compounding at a rate that justified a forward multiple of roughly 80 times earnings. By May 2026, the stock had fallen to approximately $88. Even at that level, Netflix trades at roughly 28 to 46 times earnings, depending on the metric used. The sector median for media diversified companies is 16.89 times. Netflix, at its lowest recent price, still carries a premium of 1.6 to 2.7 times its own industry peers. The stock priced a world where Netflix kept growing fast indefinitely. That world ended. The repricing has not finished. Most people watching this video do not own Netflix stock. They do not think about NFLX when they check their retirement accounts. They should. Netflix's market capitalization places it among the 30 largest companies in the United States by equity value. Standard weighting methodology allocates index holdings proportionally. Every person holding an S&P 500 index fund, a NASDAQ 100 ETF, or a target date retirement fund through a 401k owns Netflix automatically. When the stock fell 34%, the loss moved through those funds silently. No alert, no confirmation prompt, no active decision required. The $90 billion in erased market value did not stay on Wall Street. It distributed itself across millions of retirement accounts that never chose to be in the streaming business. If this content is connecting something you haven't seen reported elsewhere, subscribe now. More of this every week. That is not a Netflix-specific risk. It is a category risk. Disney faces the same content spending pressure with lower operating margins than Netflix. Warner Brothers Discovery carries approximately $43 billion in legacy debt from AT&T's 2018 acquisition of Time Warner, the deal that eventually proved too expensive to hold and was spun off at a loss. Paramount Skydance's proposed counterbid for WBD was described in filings as carrying junk credit ratings and negative free cash flow. The streaming industry collectively is running content arms races funded by borrowing against subscriber growth that is slowing across the board. Netflix is the most profitable company in a structurally indebted sector. That is not a safe position. It is the last stable platform before an unstable floor. AT&T paid $85 billion for Time Warner in 2018. By 2022, it had spun the division off. $43 billion in debt transferred to the new company. Admitting the price had been wrong, 4 years later, Netflix tabled an $82.7 billion bid for the same studio assets. The parallel is not subtle. The same content library, nearly the same price. A different company, the same logic, the same structural bet that owning the IP would justify the leverage. Netflix did not close. AT&T did. The difference is the size of the hole left behind. The telecom fiber overbuild of the late 1990s followed the same pattern at scale. WorldCom and Global Crossing borrowed to build capacity on the assumption that demand was infinite and growing. When demand normalized, the capacity became liability. WorldCom filed the largest bankruptcy in U.S. history in 2002, $107 billion in assets. Global Crossing filed the same year. The content streaming industry is not building fiber. It is building libraries. Content libraries have residual value. IP survives. But the structural logic, borrow now, monetize demand that must materialize later, is identical. Cisco is the cleaner precedent. Cisco was the real winner of the dot-com infrastructure boom. Real products, real revenues, real customers, real margins. The demand was not manufactured, and the stock still fell 89% from its March 2000 peak to October 2002, from $77 per share to $8.60. It took 20 years to recover that level. The destruction was not fraud, it was repricing. The market decided that even the genuine winner of a build-out cycle was worth far less than the build-out's growth assumptions implied. Netflix is the genuine winner of the streaming era. That is not in dispute. The platform works. The recommendation engine is real. The global delivery infrastructure is real. The password-sharing monetization mechanics produced actual new subscribers. The ad tier is being built on proprietary technology. None of that is impaired. What is being repriced is the assumption that the genuine winner gets to keep growing at rates that justify a multiple 6 times its sector median. That assumption drove the stock from $169 in intrinsic value to $1,100 in market price. The gap was not ignorance. It was a collective bet on a future that required either an $82.7 billion acquisition or a $20 billion annual content machine to manufacture growth that the core business can no longer deliver organically at scale. The workers who depend on that content machine are watching the same math. Hollywood production crews, writers, directors, and contractors operate on project-based employment tied directly to studio and platform spending volumes. The $18 to $20 billion annual content budget is not just a balance sheet line. It is the funding source for employment across California's entertainment sector. A structural pullback in that spending, not a collapse, just a slowdown, translates into fewer productions, shorter seasons, smaller slates. That outcome arrives quietly. It does not appear in an earnings call. The crash is not the end of Netflix. The recommendation algorithm still works. The global subscriber base is real. The infrastructure is not going away. What is ending is the story that 301 million subscribers guarantees infinite growth, that content spending without a ceiling produces compounding value, and that the dominant platform in a mature market deserves the valuation of an early-stage disruptor. AT&T told that story. It ended with $43 billion in debt transferred to a company Netflix later tried to acquire. WorldCom told a version of it. Cisco did not even need to tell it. The market told it for them. The technology survived every one of those crashes. The premium that the market attached to the growth story did not. Subscribe if you want to see the next chapter before it becomes a headline. Netflix had its best year in company history. The stock fell 34%. Both facts are true. The first one describes the business. The second one describes the bet. The business is real. The bet was not the business. It was a story told about the business. That it could grow without limits, borrow without consequence, and acquire its way past every ceiling. That story is over. What remains underneath it is a profitable company with $24 billion in content obligations, a maturing subscriber base, and a content bill that its own CFO says has not reached its ceiling yet. The fantasy does not have to die for the technology to survive, but the fantasy was always a separate thing, and it is finally getting what it deserves.